Folks, I want to show you something really, really cool today. Now, I know a lot of you are nervous about market direction. You don't know where the markets are going to go. So let me show you a cool trade that's setting up right now that you could take advantage without having to figure out market direction. As a matter of fact, instead of figuring out where the market is going to go, all you have to do is figure out where the market is not going to go. So this is a chart of the VXX index. This tracks the S&P 500 at the money options. The more nervous the market gets, the more scared the market gets, which happens when it goes down, the more higher this, let me do a little line chart for you to make it easier for you. The higher this goes. The more complacent or the greedier market gets, the lower volatility goes. So more fear, market goes down, VIX goes up. Market goes up, VIX goes down. So VIX trades opposite of the stock market. Now, it looks like this coronavirus is starting to peak out, and it looks like volatility is moving down and down and down. As a matter of fact, the market's been moving up, the market's been going down the last 2 weeks, but as you can see here, volatility has been going down. So what I'm going to do is show you a really simple income trade, how you can make money that goes instantly into your account without having to figure out market direction. So let's assume that volatility is going to stay below 4150, 4180. Let's say we expect it to drop, all right? Let's say we expect to continue seeing the market go higher and volatility subside. Remember, if market goes down, then volatility goes up. If market goes up, volatility goes down. We're expecting market to go up, so we're expecting volatility to go down. We're not giving exact price levels, time frames, just simple up or down. So in this case, we're going to look at the options for the VIX that expire. These options expire 11 days from now. And since we believe the market will stay below 41, we're going to sell the 41s and we're going to buy the 43s in case we're wrong. So if we're wrong, our risk is only between 41 and 43, which is only $2. 41, all you have to do is take these two strike prices and see what the difference between them is, and that's your max risk, plus you get to keep the premium. So the difference between 353, 268, roughly 90 cents. All right, give or take, we're just going to ballpark it, 90 cents. That means if the VIX stays down or continues moving down over the next 11 days, we get to keep about 90 cents, and our risk is $2, but we always get to keep the premium whether we make money or not. So if this VIX went all the way up to 50, back up to 50, and if we lost our $2, we'd still keep the 90 cents. So our risk here is only $1.90, and our profit potential is 90 cents. But again, we don't have to figure out where the market is going to go. We're figuring out where it's not going to go. And we get that money deposited instantly into our account. We get the difference between 353 and 258. I'm just ballparking the numbers. I didn't have time to calculate or any of that. But we would literally press sell 41 strike price that expires in 11 days, and we would buy the 43 strike price that expires in 11 days. The key to making this work is the expiration has to be the same and the strike prices have to be from the same option chain. So it has to be the same ticker symbol, the same expiration date, and it has to be either both calls or both puts. That's it. Again, the risk is the difference between these two strike prices minus the premium. So if we were to receive $1 from this trade, then our risk would only be $1. Making $1, risk $1. But here, all has to happen for us to keep the money is that this VIX has to be below 41.71 over the next 11 days. That's very, very likely, and we get to keep the whole thing just like that. Again, we could set this up on the bear side. We could set this up on the call side. We can change our expiration going forward several months. For example, take in more premium, but in this case, we would have 95 days till expiration. And in this case, let me just show you the premium. You're talking about 90 cents of premium here. Again, there are many, many different variations, but it's real simple. Each trade has two sides. There's a buy and a sell. The risk is the difference between those two sides minus the premium. The premium you collect right away. You know exactly where your risk is, where your profit potential is. You know exactly where your break-even level is. You know everything about the trade ahead of time. Folks, I love these trades, especially in markets like this where volatility is really high because the premium balloons up because trading range is expected to go higher. So volatility is high. It gives you more premium, more money for lower risk. Folks, I love these trades when the market goes haywire like it is right now. This is time for easy pickings. Hope that helps. Folks, Main Street Americans are finally weaponizing a hedge fund super strategy to collect instant income in any market. And now, you have the chance to join their ranks. Tomorrow at 1 p.m. Eastern Time, I'm teaming up with James West to bring you one strategy that could pull a minimum of $1,000 out of the market every week. Inside our presentation, you'll see how to raid huge companies like Amazon, Facebook, Tesla, even Google. After over 30 years of executing this little-known strategy, it's safe to say that this alternative income source has gotten me through some of the toughest times ever. Click the button at the bottom of this video or at the bottom of the page to take advantage of the strategy. Do it now.